this is all going to reverse at one point. An uncontrolled sell-off in the debt market is going to wipe out the value of world equity markets on a grand scale. It's just cash bleeding out of the debt market, putting pressure on world stock markets, and cash is just going to move. It's just cash moves through the markets in relatively predictable patterns. Risk on turns risk off. Once the cash is bleeding out of the debt market, bleeding out of the stock market, it's going to make its way, in my view, into commodities. I mean, in general, commodities here are going to take off. It's just a matter of time, but that moment won't happen until we see the debt market actually melt down.
The sharp rise in Treasury bond yields has prompted warnings from the International Monetary Fund, which has called on regulators to increase their oversight of financial markets. When you see large, fast moves, there is a greater potential for triggering instability because market participants have to reposition, and there are accelerators in the system that could come into play, said Tobias Adrian, who heads the IMF's Monetary and Capital Markets Department. This warning comes after Treasury yields reached highs not seen in nearly 2 decades during one of history's most extreme U.S. bond sell-offs. According to Gregory Mannarino, the debt market is experiencing an uncontrolled sell-off, which could eventually have a significant impact on global equity markets. When the debt market undergoes a significant sell-off, it can trigger a shift in cash flows. He anticipates this will increase commodity investment, making them an attractive asset class. Billionaire investor Ray Dalio also warns, "We're going to have a debt crisis in this country." He points to projections showing that the U.S. national debt will balloon to over $52 trillion by 2033, with an increasing share of the federal budget dedicated to paying interest. Gregory highlights that the current environment, characterized by attempts to hyperinflate the system while it remains heavily saturated with debt, necessitates inflation on a global scale. There will likely be a continuation of this sell-off, potentially surpassing previous events. Central banks actively buy debt to stabilize the market, even if it requires unconventional methods. While this temporarily stabilizes the debt market and propels equities higher, it merely keeps the door open for cash to flow into risk assets. Eventually, the risk-on phase will turn into a risk-off phase, a move that Gregory suggests will be orchestrated rather than accidental. We will now present clips from Gregory Mannarino's interview with WT Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I mean, going back to what we were talking about before, the debt market sell-off here, there's a moment here, and I think we're in it now, but they're trying to hyperinflate it even further, of maximum saturation, meaning the system is, even though the system is saturated in debt, it operates in a constant deficit. That's pretty much a fact. But what's the opening act of a maximum saturation situation? It's pretty obvious to me. You have to have inflation on a grand scale, in other words, around the world. That's clearly what we're seeing here. The debt market sell-off is a part of it as well. They don't want to hold this anymore. There's going to be a moment here where we're going to see a continued sell-off in the debt market, which is going to eclipse what we've seen recently here. Much worse here, because again, this whole thing has to reverse. Central banks in here buying it all, trying to stabilize the debt market via any mechanism that they can. If they have to institute more war, that's exactly what they're going to do, and that will, for a moment or two, stabilize the debt market here and allow equities to go higher. All it does is keep that doorway open for cash to make its way into risk. But risk on eventually will turn risk off. And look, it's going to be at a moment more than likely of their own choosing. I've been telling people this for the longest time. Nothing is by accident, nothing at all. So when these kinds of things happen here, and we're going to know again. I've been telling people, I don't know how long now, during the debt market sell-off, which was pretty profound. As a matter of fact, Bank of America said this has been the biggest sell-off in history. It's been a profound problem for these institutions with regard to their balance sheets, the value of their debt and what they're holding. But anyway, so this is all going to reverse at one point. An uncontrolled sell-off in the debt market is going to wipe out the value of world equity markets on a grand scale. People were telling me, all right, when this war thing broke out, my email box lit up like, I don't know, all the stars in the sky. Greg, come Monday, the market's going to crash. The market's going down. We're going to lose thousands of points. I said, no, it isn't. No, it isn't. Watch what's going to happen. Debt market's going to stabilize. Stock market's going to go up. Oh, no, Greg, you're going to be wrong on this one. I wasn't wrong. It's just so simple. You got to understand what they want to do. And this is about stabilizing the debt market now to keep the illusion of the market real. But it's not going to last. It's not going to last. They need another event, something bigger, to occur. And they will. Okay, but people need to be ready for it. And people need to be positioned correctly as well. I mean, look, what do I tell people? I feel like still commodities are the place to be. Super undervalued ones, in my view. Silver, my favorite asset of all time. Then would come gold and platinum, palladium, third. Both of them. And then, I mean, in general, commodities here are going to take off. It's just a matter of time. But that moment won't happen until we see the debt market actually melt down. See, look, people are always looking in the wrong spots. You watch CNBC, Bloomberg, Fox Business, whatever it is. They're all telling you to focus on the Dow, 30 companies. Forget about the broader market. You focus on that Dow Jones Industrial Average because that's where we're telling you to look. Because that's what they want you to do. But the issue is the debt market, which is the driver. That's where the big event that everyone's waiting for is going to eventually occur. And again, understanding that the stock market derives value from the debt market. Well, what do you think that means? I mean, again, cause and effect. Very simple to understand. I mean, just, here in the United States, and I urge people to do their own research on this. We have the debt now going up at over $1 billion per hour. Do people really believe that's sustainable, especially in this environment here, where things are going here? But it's going to go on. It's going to continue on. And the situation is going to get worse and worse until it doesn't.
There is a growing realization in financial and media circles that the sell-off in the U.S. bond market, marked by a rapid rise in interest rates, is the outcome of profound shifts in global financial markets. The initial hope was that the turbulence was merely a response to the interest rate hikes by the U.S. Federal Reserve over the past 18 months, taking rates from near zero to over 5%. The expectation was that after some initial turmoil, stability would return as the market adjusted to the understanding that rates would remain higher for an extended period. However, this perspective is now giving way to the understanding that the era in which the escalation of U.S. government debt could seemingly be endlessly financed due to historically low interest rates has come to a close. Gregory underscores the need for a continuous influx of cash into the system to sustain the flow of debt, suggesting that another significant event or a potential false flag operation may be required to achieve this. The overall financial system operates in a constant deficit, and the true scale of the debt and its associated derivatives is challenging to measure accurately. Let's get back to the interview.
In the short term, again, what they're doing here is they're trying to stabilize the debt market. They had to stop the bleeding. Talking about the sell-off that we were seeing in the debt market, which you had mentioned just a little while ago here. They had to find a mechanism to stop the bleeding, period. The stage has been set from a long time ago. They're telling us that there's some kind of an intelligence failure. Meanwhile, we're finding out there were all these warnings about it. All this stuff on the news right now. Okay, the stage was set. They knew Wall Street was obviously well informed that this was going to happen, henceforth why the stock market rallied on Friday. And, just a coincidence that the bond market was closed on Monday, so start the war over the weekend here. It's the time. Look, none of this is by accident. I think that's pretty clear. Should be, at least to everyone that's watching this. But so right now, what they're going to attempt to do is stabilize the debt market, but it's not going to be enough. This war, we're in a liquidity crisis. Cash is drying up, period, the end. Okay, in order to keep the flow of debt into the system here, this must expand. Another false flag is going to happen, something bigger. And every one of these kind of events must eclipse the one before it. They must find a bigger reason to pull more cash into the now. People can't be told this stuff, that the system is illiquid, that the system operates in a constant vacuum, a constant deficit. They don't know that. People believe that this is a normal functioning system. I mean, just to put another perspective on this, and I urge people to do their own research, go to the Federal Reserve's own website. They'll tell you how much cash is actually in existence. It's $2.3 trillion of US dollars. The rest of it doesn't exist. It's not on the elemental chart. Okay. Near $34 trillion in debt that we owe, it's not there. It's just not, just like people's bank accounts. You think when you go to you open your website and you look at all those beautiful zeros on your bank account, it's not there. It's just digits on a screen. It doesn't exist. The whole system is imaginary, and it's going to get very real. That's my take on it. I love it what they do. when people they're told, oh, okay, the debt is X amount of $1 trillion, but this is just, the scope of this all. You have to factor in all the derivatives associated with it, the dollar-denominated derivatives. It's in the quadrillions, but even that is all of that stuff is you can't measure it. There's no actual way to know what it is, but we know that number is astronomically higher than what they're letting us know. Everything when they float out these numbers at face value, you have to understand that there are layers and layers and layers and layers of derivatives on both sides, and it's just crazy to think about it. No one can know how big it is, but I can tell you it's not pretty. I think the worldwide financial banking system is in a lot of trouble here. It's not just here in the United States. And I tell people all the time, stop thinking just in wherever area you live in the world. The system is run by the central banks, and they're all working towards a similar goal. The banking system around the world is insolvent, operates in a perpetual deficit. And again, the world is going to pay the price. The people of the world, unfortunately, are going to pay the price for this, and they're paying for it now. Some people are paying for it with their lives, and they will slaughter. And I've told people this for 10 years. They will splatter our blood and guts all over this planet to keep the current system going. That's all this is about. Our lives are worthless, and they're going to float out the politicians and then tell, oh, what a tragedy this is. Or a war is, but they know the game. I mean, all of them around the world, they know where this is going. They know how the game is played. Unfortunately, they can't tell you because they'll probably end up with a bullet in their head or something along those lines here. But well, that's just the way it is. Wow, this market is it's up over 200 points right now. That's on Bostic. When President Bostic came out today, and we called it. I called it this morning right on my blog before it happened. I don't know if you saw it. I said, watch what they're going to do. Don't be surprised if they float out a Fed president. He's going to ease the market, talk the market higher. He's going to tell you everything's going to be okay, and the Fed doesn't need to raise rates. Oh, well, that's exactly what happened. I mean, we know their playbook cold. It's so obvious when you know their goals, we know what they want to do. What is this? What's the goal of every central bank on this planet? To be the lenders and buyers of last resort. They run it all. They run the economy. They run the financial system. They run the financial markets and everything. And the flow of information. I mean, this is the one world government that we've been told about. I mean, go to the BIS website. They're going to tell you their mission. And that's basically to conquer the world without firing a shot.
As precious metals like gold and silver possess intrinsic value due to their scarcity and durability, when there's a debt sell-off or concerns about the stability of fiat currencies, people often turn to gold and silver to preserve their wealth. This increased demand for these metals can drive up their prices. What is your perspective on the potential risks posed by the current state of the debt market? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.